In economy, we'll begin with markets as usual. Markets, the Dalal Street witnessing a heavy sell-off today. Run us quickly through how Sensex and Nifty settled this afternoon.
So Shweta, today the markets opened on a weaker note and Nifty and Sensex, both the headliners, continued to decline through the session, although there was a minor uptick. But Nifty and Sensex closed almost 1% lower in today's session. Now at close, Sensex was down. At close, Sensex was down about 1.02% at 65,782 levels. It touched an intraday high of 66,000. As you can see on the screen, Sensex is down by 1.02% and Nifty ended 1.05% lower at 19,526 level. Now Sensex touched an intraday low of 65,431 levels, Shweta, and an intraday high of 66,261 levels. Now on the other hand, Nifty 50 touched an intraday high of 19,678 and an intraday low of 19,423. The sell-off was broad-based. Nifty mid-cap 100 and Nifty small-cap 100 underperformed the benchmarks and ended Nifty mid-cap 100 ended 1.33% lower and Nifty small-cap 100 ended 1.58% lower.
All right. Also joining us on this show, apart from Suyash, is Rajesh Agrawal, who's the head research of AUM Capital Markets. Before I go to Rajesh, I also want to quickly understand from you, what are the sectors and indices you were tracking today?
Shweta, the sectors and the sell-off was broad-based. Most of the all sectoral indices on NSE ended today's session lower. Now the sell-off was primarily driven by banking stocks. Nifty Bank was down 1.31%. Nifty Auto was down 1.66%. Nifty IT was down about 0.81% and Nifty Pharma was down about 0.42%. The banking stocks,
all indices closing in red today.
Yes, for sure.
Almost all indices closing in red. Let's quickly get in Rajesh, who is with us at this point in time. Rajesh, appreciate you taking time out. Good afternoon. I want to quickly understand from you, what's hurting the sentiments on Dalal Street?
Good afternoon, and thank you for calling me. We have seen that markets have seen quite a good run-up in the recent past, from March lows to July highs. It was a spectacular run based on my macro data, the FI inflows or something like that, and it was just waiting for a trigger to have some profit booking or do some correction. 19,992, which was the recent high or the all-time high of Nifty, seems to be a resistance right now, facing a tough resistance to clear. I think it will act as a resistance for quite some time before some major positive news comes in. And what happened exactly today was it tracked all the Asian and global markets which were slumping, where there was a steep selling across Asian markets. Across the board, sell-off was witnessed after Fitch ratings downgraded the US sovereign credit grade. And this triggered a spike in US yields. Benchmark 10-year bond went over 4%, and that was a trigger which evoked a risk of sentiment. And declines have outnumbered advances in the market. Downgrade of the US market, though, would not have major impact on Indian market as far as I understand. It is unlikely to be a major concern because US economy is now headed for a soft landing and not a recession as market had feared earlier.
So Rajesh, I want to discuss Fitch's downgrading in detail in just about a couple of minutes from now. But before I do that, I also want to ask my colleague Suyash to quickly run us through who were the top gainers and losers in the stock market today.
Yes, Shweta. So among top gainers, if you can have the top gainers graphic on the board. Yeah, so DB's Lab was a top gainers today's session, followed by Nestle India, which was up about 1.21%. Hindustan Lever also performed well. Consumption stocks, it seems like bucked the trend today. As you can see, Asian Paints and Ultratech Cements also fared well in today's session. Now among losers, if we can have that graphic also. Hero MotoCorp continued to decline for the second straight session after a 4% loss today. The stock ended about 3.39% lower, followed by Tata Steel, which was down 3.33%. Tata Motors, which saw a decline in sales in July by about 4%, was down about 3.13%, followed by Bajaj Finserv, which was down 2.86%, and NTPC, which was among the top gainers recently, saw some profit booking in today's session and was down about 2.69%.
All right. What explains the fall in Tata Steel stock? Perhaps Rajesh can also weigh in. Rajesh?
Yeah, see, metals have seen a sell-off because of the yen appreciating, dollar index going back above 100, 101, and that's one of the reasons. We have seen crude again inching up, dollar inching up. So that's some of the reasons that might have triggered a sell-off in metal stocks, and not to forget the kind of run-up they have witnessed in the recent past. The profit booking was just going to happen, waiting to happen, I would say. And just a profit booking, I would say, it's not something like a crash, or people should not be scared of this fall. I think this is an opportunity to accumulate. All
right, it's not a crash, it's profit booking. Is it likely to stay on? Are we going to see this happening in the next couple of sessions as well? What are you picking up?
Maybe quite possible. One or two sessions there might be some profit booking further, but since we are in the mid of result season, we might see numbers coming out, and that would play the game going forward. I don't think this US downgrading would be a major factor going forward.
Okay. Since we're talking about numbers that are coming in by the way of quarterly earnings, what are the quarterly earnings we are tracking, Suyash, this afternoon?
Shweta, Ambuja Cements came out with its Q1 numbers earlier in the morning. Now, Ambuja Cements outperformed, like exceeded Street's expectation, although it posted a loss of about 38.5%. Now, the loss was primarily due to the base effect, as the component of other income was much higher in the previous like in Q1 FY23. So apart from that figure, which was due to the base effect, all the revenue numbers, the EBITDA, the margin have exceeded Street expectation, and it seems like the company has done fairly well in the previous quarter. Now, the stock also bucked the trend in today. Although it ended lower, it was down about 0.14% in today's session.
So not too bad there as far as stocks is concerned. And perhaps we're also tracking Wilmar results.
Adani Wilmar is set to be out now. This will be the third company from the Adani stable to report its set of earnings. Now, usually Adani Wilmar is expected to report a good set of numbers in line with most of its peer companies in the Adani stable. So we'll see how those numbers pan out. Another one is Titan, which is also
and
due
in fact,
today.
Yes, we were discussing it in the newsroom. Junjunwala's favorite, Titan, came up with its results. What are the numbers looking like?
So Titan is yet to come out with its results. The expectations are that it will post about a 17 to 18% year-on-year rise in its net profit from about 793 in Q1 FY23 to about 923 crore. Now, this is according to analyst expectations. We have collated brokerage views of about 10, so they are expecting about 923.2 crore figure as far as net profit is concerned. We also are expected to see a 20% rise in revenue from about 8,961 crores to 10,723 crores. Now, margin is also expected to go up, but not as much as the figures that you see next to revenue and profit. At least as per the expectations of the brokerage, there will be a slight improvement in the margin from about 13% to 12.77%.
All right, and if Titan lives up to those numbers, I am hoping Mr. late Rakesh Junjunwala would be happy in his grave. But we're going to move on for now and move on to another important story that we're tracking, and that is by the way of global ratings agency Fitch has downgraded US sovereign ratings from AAA to AAA plus on the back of expected AA plus on the back of expected fiscal deterioration over the next 3 years, high government debt burden and steady deterioration in governance over the last 20 years. Obviously, White House and US Treasury are critical, not very happy with the downgrade. In 2011 as well, S&P downgraded the US ratings from AAA to AA plus for the first time in 70 years. We continue to have Rakesh with us at this point in time. I quickly want to understand from you, sir, what explains Fitch's rating and downgrade?
See, the huge debt which they have, almost 1 trillion of interest burden every year, that explains the kind of things. And the growth is faltering, high interest rate is again making the problems go, multiply the problems, I would say, and every time Fed increases the rate, the burden increases. So I think this is one of the reasons, and the poor governance, which was stated in the report, maybe the other reason. So these are three reasons which have been triggered this downgrade.
All right, Suyash, we were hoping to discuss the impact this is going to have on the bond yields and money that will flow into Indian markets, perhaps, or perhaps Indian startups. And you had an interesting perspective coming in there.
So, Shweta, what happens when a downgrade occurs is that the debt, in this case US debt, it becomes less lucrative, because what essentially Fitch is saying that the chances of default for the US government are higher. So now when the debt or the demand for US debt falls, the prices will fall. But now, since there is an inverse relationship between bond prices and bond yields, the yields have gone up, and yields have spiked up as much as 4%.
All right. I want to quickly also understand from you, Rajesh, are we hoping to see some of this money which has been parked with US Treasury bonds come into India in the near future? Perhaps startups which have been languishing in absence of enough funding?
I don't think so. It would be so fast. Maybe after some time it might happen, but not in the near future.
Not in the near future. What does it really mean for US economy?
See, US economy, I don't think major impact is going to be there, because it's already reeling under debt, and the bond yields has gone up over 4%. That would be a problem for a short term, but we should not forget that there were concerns of recession in the recent past for US, but it's not going into recession, it's going for a soft landing. And that's one of the positive which I look at through US economy.
All right. What impact is it going to have on US stocks? Dow was up 0.2% as of yesterday. US markets are yet to open up. But what sort of impact are you anticipating in the US markets and on Asian markets? We've seen a major sell-off in Asian markets at least so far.
Asian markets have already seen a sell-off today, and I think if it may continue for 1 or 2 days max, further going ahead. But as far as US is concerned, I think today it might open down. But again, as I said, earnings season is going on not only in India but in US also, and that will overtake the other sentiments.
So, apart from US downgrade today, we had seen that, FIIs had turned net sellers recently. So, is it that, the Fitch downgrade acted as a catalyst because the market was facing resistance at higher levels?
See, market has been going up since March lows. We have in March, July highs. So it's almost 10-15% run up from there. In fact, more than that. And it was just waiting for a trigger for profit booking. And this is just a profit booking. If you look at 5 months figure, every month we had positive inflows from FIs. So it's just a matter of fact that they resorted to profit booking in some of their counters. So it's not a major concern, I would say, unless, of course, the selling continues for some more days. That would be a concern. But then domestic investors have been quite a buyer in the market, and we have seen whenever FI sells, the I buys almost all the same quantity, because we should not forget that SIP inflows are continuously coming in the markets.
DIIs have been buying, and because of their consistent buying, the market, at least before today's fall, did not really witness any major sort of profit booking. So, is it because of the Q1 earnings? What's giving confidence to domestic institutional investors?
See, Q1 earnings have been mixed. It's not that every company has reported very good numbers. Today, even we have seen Adani Wilmar giving out loss in against profit in the last quarter, year on year. So numbers have been mixed, but the management commentary of almost all the companies has been very encouraging. And this correction was waiting to happen. And this is giving an opportunity for medium to long-term investor to acquire good quality stocks. Somebody was feeling very spectacle going for some stocks at some prices. And today, if you are getting a 10-15% down, then it's a very good opportunity, I would say.
All right, Mr. Rajesh Agrawal, thanks very much, sir, for taking time out. Suyash, thanks as usual for bringing all the updates related to stock market. We'll of course keep coming back to that big story, but moving on for now, the question whether Tesla is coming to India, and the question has since moved to when is Tesla coming to India? As Tesla explores possibilities of having a manufacturing plant in India, the Indian government has suggested Tesla executives to find local partners to collaborate with Chinese suppliers. My colleague Amit has just walked into the studio here. Remember, the talks between Tesla and India executives is currently on. It's going on at full force. It's a matter of when Tesla comes in, not whether Tesla will come in.
Okay, now Tesla has a little problem, and that's a problem with the ecosystem that is coming up in India. If Tesla wants to keep its prices down, it needs certain components from Chinese suppliers. Things like battery cells, even Tatas for the electric vehicles import these battery cells from Chinese companies. What the government is telling Tesla is find local vendors. There are no local vendors for battery cells for electric vehicles. So to go around that process, because Indian authorities aren't really warm to Chinese companies coming to India.
They're cracking the whip on Chinese companies.
So they have advised Tesla to go the Apple way, that the Chinese companies form joint ventures with Indian vendors. And that is how they can still get those, especially battery cells, from these Chinese companies. Tesla wants to set up their manufacturing facilities of electric vehicles in India, not just for the Indian domestic markets, but for exports as well. And they're looking at their $24,000, which is close to 24 lakhs electric vehicle car, to be manufactured in India. So that is one. Now, the whole ecosystem of electric vehicles is slightly bigger than this. Foxconn, which is basic.
In fact, I was about to come to that. Tesla, if and when it enters India, and as I said, we began by saying it's not a question of whether, it's a question of when. They are in advanced talks. Tesla executives have been visiting government for over 6 months now.
Yes.
And the conversations have progressed now to finding local partners for EVs, for different parts and supplies. So those are the stages at which the conversations are happening at this moment. But also Foxconn and its plans for EV in India will prove to be a competitor for Tesla.
No, not at all. So it's a whole EV ecosystem that is happening in India. Tesla is one part of it. Foxconn is not looking at four-wheelers. They are looking at three-wheelers. And under their radar, they have convenience stores, car rental companies, courier companies, which will use these vehicles. And they are looking at the low-powered EV market. Okay. So that is what Foxconn is looking at. Foxconn, and all of this requires semiconductor chips. So it's a whole ecosystem. Foxconn is into that. They are investing another $600 million in Karnataka for chip manufacturing in collaboration with Applied Materials from the US. To cater to this market and more, there's another Japanese company, Disco, that is coming into India, which is setting up an outlet in India to supply chips for this whole industry.
Okay.
So electric vehicles,
so for EVs you need batteries, for batteries you need chips, and you need an entire ecosystem. And for chips you need lithium. So there is a whole ecosystem that the government at this point in time is trying to cater to, trying to bring in here and ensure that it's all made in India from beginning till the end.
All made in India, but a little bit of skin in the game will still be from China.
Okay, and a lot of skin in the game will be from the Indian government, which is what we were discussing. So there is a red carpet that is being rolled out, not just in terms of policy promises, but also actual monetary help.
Of course, India with the Foxconn and most of these semiconductor chips, 2/3 of the investments is coming from center and states, and just 1/3 is coming from these foreign partners. So a lot of skin in the game, but that's mostly in the chips thing. I do not think in Tesla it is 2/3 to 1/3.
Okay.
Tesla will still have a major stake, but yeah, so it's an entire ecosystem.
All right, it's an entire ecosystem, and government, of course, trying to build that ecosystem very, very fast.
And at high speed.
At a very high speed. Amit Ranjan, thanks very much for joining with your inputs on that very crucial story. Moving on now to a story that we continue to track since this morning, which is the 50 first GST Council meeting that is happening now as we speak. A lot of gaming companies are going to be eyeing this meeting very, very closely. Why? Because in this meeting, modalities of the 28% GST levy will be discussed and arrived at. Gaming companies, of course, hoping that there will be some tweak. 28% could be down to 18%, but it's all wishful thinking at the moment. It may not happen. Karthik Malhotra walking into the studio to give us more details.
Good afternoon.
Good afternoon, Karthik. Gaming companies, of course, hoping things will change for them. Their fate will change. Very unlikely.
I'm not sure what their hopes are pinned on right now, because from whatever we are picking up right now, it seems highly unlikely that there is going to be any tinkering on the 28% GST on face value for online gaming companies. So, yeah, I think at best what they can do is a prayer, a little bit of worship. But beyond that, I think whatever influence that they thought they would have had on Finance Minister, on the GST Council, I think a lot of that seems to be waning now, simply because from whatever we have picked up so far, it seems highly unlikely that there is going to be any change of heart, change of mind, change of decision as far as the 28% GST on online gaming, face value of receipts on online gaming goes. So 4 o'clock is when the meeting was scheduled to have started.
So
I think
it may just have started now.
Yes, so we are hoping that the meeting should end soon enough. It's a virtual meeting. It's not a physical meeting. Finance ministers, members of the GST Council are all connecting virtually. They are all going to connect online. Of course, we know for a fact that that this debate on distinguishing between game of skill and game of chance is on agenda. Any potential tinkering, rollback, reclarification, redefinition
retrospective
of online gaming, retrospective technical facets on what happens if you were to start into a gaming, onto a gaming platform with a 100 rupee upfront payment, which gets taxed, and then you were to transfer that onto a wallet and then come back onto the platform, then there's this question of double taxation. Every time you come in without winning or losing, will you be charged the 28% GST? So these are technical details which will have to get thrashed out. I think what the government, what the GST Council, what Finance Minister Nirmala Sitharaman should be cognizant of, and I believe will be cognizant of, is the fact that there are international platforms which may choose to not register their outfits in India, may find ways to circumvent this 28% GST, and therefore attract Indian gamers to play on platforms registered outside the shores of India.
All right.
And that, I think, instead of the whole conversation being around increasing taxes, increasing tax income for the government, may actually result in siphoning off of money to shores outside of India.
All right, and we here at Newsline have in fact documented the growth in online gaming industry. I would request, of course, my team to play up that documentary that we made in a couple of minutes from now. But essentially, the crux of the debate on your screens at this point in time essentially means that for every game that you play, for every gamer who gets on or hops on to a gaming platform in India, will have to pay 28 rupees for every 100 rupee that they are putting in the game. And that is an outgo for the government. You play with what, 72 rupees, if my maths is correct?
Absolutely. So I think that is what the whole concern is, that a gamer comes with 100 rupees hoping to, in a real cash game, hoping to, let's say, make 10 rupees out of his winnings. Now, 110 rupees is what the gamer should walk out with. Now, what this 28% GST on face value will entail is that you walk in with 100 rupees, 28 rupees straight away goes to the government. So for you to make the same 10 rupees profit, now you need to recover that 28 rupees first, and then make a 10 rupees. So you need to actually make 30,
at least 28 rupees.
28 plus 10, right?
Right, to make 10 rupees
38
profit.
Rupees. You'll have to make 38 rupees profit on 100 rupees that you invest to actually walk away with 10 rupees of winning, right? Now that becomes, obviously it reduces the probability. How many games will you have to play and how much will you have to win to be able to make a 38% killing on your investment?
So if you
for gamers, it is definitely, so I mean,
if you earn 28%, you're still not earning any. 28
if you
rupees,
earn 28 rupees on the 100 rupees you played with, you have walked fair and square, zero. No earning, no loss,
net
right?
Zero.
But if you want to make even a rupee, you actually have to make 29 rupees. So that is the concern of the gamers to begin with. That obviously becomes a concern for the gaming platforms, because on what basis do they attract people to come and play on their platforms? And if people don't come and play on their platforms, they go out of business. I think this whole game, with so many gaming companies mushrooming, in fact, the Newsline Plus team had interviewed and gone and spoken to gamers as well as cafes where people come and play. And this was done about a year ago, right? Where there was still confusion, if you remember, on
around
whether
GST.
On GST, on the rate of GST, and also whether GST needs to be paid on face value or on the platform fee. For example, the same 100 rupees, you play with 100 rupees, maybe the platform charges 10 rupees as platform fee, and you have the balance 90 rupees to play with. In the case of face value, 28 rupees is charged on the 100 rupees, which is 28%. What the gaming companies were paying up until now was in fact 18% on the platform fee, which means the 10 rupees that they deducted from the gamer on the platform fee, they paid an 18% happily, resulting to 1.8 rupees. So 1.8 rupees per 100 rupees versus 28 rupees per 100 rupees coming into the platform is obviously a matter of huge concern. And this industry, incidentally, had done revenues of about $10 billion last year. For a nascent industry, for a nascent sort of, a large population taking on to these nascent platforms, I think if this rollback does not happen, or a tinkering does not happen, or this clarification on whether it should be face value or platform fee doesn't come through in favor of the industry, it seems very difficult for this industry to compete, and that is the concern of the gaming platforms.
All right, so it feels that online gaming industry platforms may not be able to compete, at least with their foreign partners, unless of course in today's GST Council meeting there is some sort of tinkering on what was announced in the last GST Council meeting, and foreign players are also brought under the GST ambit, either by the way or virtue of having a local representative. That of course is something that GST Council will be deliberating. But let's quickly jump onto this documentary that we made about a year ago. So remember, this is when GST Council had not decided of a levy, when it was all in thin air. This documentary here documents, of course, the rise of online gaming industry in India.
There is no age barrier to become a gamer.
When I played my first video game, I was then 4 years.
The Indian gaming industry is booming on a global scale.
We can easily reach to 7-8% in next couple of years.
But a government proposal of 28% GST could spell trouble.
Putting it in the same bracket is going to stop the inflow of funds which are coming from abroad, stop the growth of the industry.
This is a gaming cafe run by a young entrepreneur in the national capital. The mood is fast, exciting and addictive.
I have a stamina of playing continuously more than 36 hours. So that's why I opened this cafe. I'm a gamer myself. Like, I'm playing since I was in 6th class. So till now, I'm playing with my customers, and like whenever I get time, I do play like in daily.
In another Indian city, a teen zigzags his pro mouse across the pad as he AK-47s his way through a drug cartel in his Andean hideaway.
During my childhood days, we had a cyber shop. My dad owned a cyber shop. So we had 7 to 8 pieces installed. And one fine day when I see the customers, like normally customers come to browse, do their office stuff and so. And then I saw a customer who was playing games online. I was just wondering, I was just in 7th standard. I was wondering, okay, it's looking something interesting. What kind of game is he playing? What is it exactly? So that curiosity arises, right? So after he left, what I did was I just opened the same page which he did. So then I started playing it. So that's how all my interest started about online gaming. Then I called upon my childhood friends. Slowly the cyber center turned into a game shop as well.
Nicky could well have been the teen with the virtual assault rifle in Colombia, but he's only one among millions. Others twice as old as him are just as crazy about consoles.
Ever since I was in my engineering, I was fascinated with games. the first time I played online multiplayer games, it gave me a different perspective, wherein I could socialize with different people, I could play with different people across the globe. That was a unique experience for me. Gaming is a passion for me. I'm a mid-age guy, and throughout my childhood, I played games. And after that, after a certain time, I started off with my professional career. And it's like a balance thing. Whenever I'm stressed at my profession, and I start playing games. So there is no shift of profession or something in my mind.
The Asian gaming market was a whopping $72.2 billion in 2019, with the lion's share divided between China, Japan, and South Korea. India is at a distant fourth, but is growing at an exponential rate. No prizes for guessing why there is such a torrent of investment flowing into the online gaming market in India. The number of online gamers is expected to significantly rise over the next few years. Though the numbers point at massive market size and growth potential, the GST Council's recommendation for a 28% GST from the current 18% has sent shockwaves.
28% is done when you don't want to promote an industry. 28% is done for tobacco, 28% is done for casino, all those activity where we think it's not good for us.
From the reports, it suggests that the tax authorities are clubbing online games of skill with betting and gambling. Now, that would be incorrect, because this would be ignoring 60 years of jurisprudence involving the Supreme Court and various high courts. This would mean also that online gaming companies would have to pay GST, which would be in multiples of their revenue, which I don't think has precedent in any industry. So it would be impractical and also incorrect.
Define what is online gaming, we need to define what is betting, and then we can definitely say what are the skill-based games, what are the game of chance, and based on that, government can put a regulatory framework, what is allowed, what to the extent, what is banned to the extent. I think this is a process of evolvement.
The proposed tax slabs could stifle creativity and bog down the gaming sector.
Because it's all demand and supply chain, and until there is huge demand, they are not going to be supply. I think government should not over-regulate it. I think the government should leave it on the self-regulation model, as they have done it with news.
These companies eventually, whatever money they make, they put back into the industry by developing games for our own country. So if you consider the West has so many games that are based on their culture and mythology, but Indian industry as such, very few games are based on our culture and mythology. So those games can be built only if government gives us tax breaks, so that the same money can be invested back into building better products with higher budget.
But the question to be asked is, if the number of online gamers were to rise significantly, which is the likely scenario, will the proposed tax really act as an entry barrier?
There is a chess tournament, you go there and you pay, your ticket is paid, and 18% GST is cut. Then the organizer would earn some revenue, and he also pays 18% tax, and that's final, that's all. You take the same chess, which is on, go take it to online. Now, suddenly, the tax would be 28%. Then, to take it to a higher level, they would be talking about the total collection as something from which 28% would be taken. The whole, not the revenue the platform would earn. You can't justify putting 28% if the platform is only earning 5% or 2%.
But I think we as a stakeholders, as a federation, industry and government will have to work together and ensure that the only best and positive part of the industry remains in the market in long term, and it's in the India's interest to remain in that larger interest. If there are few elements which are disturbing or which are corrupting the entire scenario, we as a stakeholder will have to work with government on ensuring that only right people and right environment remains in the country.
With data rates plateauing and the advent of 5G, online gaming is only going to push north. But the proposed tax could be a potential counter-strike for gaming in India. All eyes are on the government's next move.
All right, that's the brilliant.
All eyes on the government's next move.
Next move, quite
which
literally.
is on right now. The game's afoot.
The game's afoot. The game's not over just as yet. In an hour's time from now, perhaps hour and a half, we'll know
if the game is over or
the game is over
a new
for
chapter, a new season to the game.
So we will have to, of course, wait and watch out for that. Hour and a half from now, GST Council, of course, will come out with its findings on what it's been deliberating so far, whether the rate is going to be changed or not. It's highly unlikely. So gaming companies will have to prepare for a better future ahead. But we're going to move on for now. China's tepid growth is dampening sentiments across the world. Chinese factory activity contracted. Data from fourth straight month suggest contraction in July. Chinese government released new measures aimed at boosting world's second largest economy. The official Managing Purchasing Managers Index came in at 49.3, below the 50-point mark that separates expansion and contraction. This, of course, as per data by National Bureau of Statistics. Now, the global factory activity remained in a slump in July as slowing growth and weakening demand in China were taking a toll in the world economy. China post-COVID recovery is proving to be a damn squib, and the country is struggling to improve growth. What is hurting Chinese economy? To discuss that and more, joining us at this point in time is Shubhada Rao, founder of QuantEco, on the broadcast. Shubhada, thanks very much for taking time out. I want to begin by asking, what exactly is hurting Chinese economy? Apart from the factory output, slow consumption, what are the pain points?
I think the pain points typically would start with the COVID era and extended lockdowns. I think China was the last of the major economies to open up entirely post-COVID ramblings over 2.5 years. Since it opened, completely opened up the economy last year, late last year, 2022, there was a wider expectation that there would be a quick rebound in economic activity, be it in the manufacturing or in the services. But unfortunately, both have stuttered, in fact, thanks to the global scenario of weakening growth momentum coming more from the developed economies, thanks to a very persistent and longer high inflation rate, leading to rising interest rates by the Fed, by ECB, by BOE, and that has overall dampened the global economic momentum. So to a large extent, this slowdown of the global economic activity also rubbed off on China. Add to that, as I said, the last of the economies to open up post-COVID had its repercussions on the domestic growth, domestic employment. Remember, China has been for some time now trying to change the growth levers from exports to domestic consumption. We cannot forget, as you rightly pointed out, the PMI data, which points to a continued contraction 4 months on the trot. But I think the key point within the PMI data would also be unemployment data. The Chinese youth unemployment, which in turn would also continue to dampen the consumption activity. Given all these scenarios and the realities of data thrown in, the Chinese government and the Politburo decided to open up a flurry of economic measures to boost consumption, including those on home sales, on real estate, which has been the longest suffering sector in the recent phase. So I think there are multifarious factors at play. Add to that, and compounding the problems, is the climate risk actually now impinging in real terms on economic activity. We just saw what happened in Beijing over the last week in terms of the pounding of rains, highest in 140 years, and so on and so forth. So you have, unfortunately, a perfect storm, what the China economy is currently facing. And, the growth, which over the first quarter to second quarter, coming at sequentially at just a 0.8%, was perhaps a big giveaway of how Chinese economy will not be able to turn to be a growth propeller for the world for a longer period and longer duration. Unlike the previous crises, be it economic or financial across the globe, China used to be the perfect buffer and shock absorber. Post-COVID era, China has remained virtually absent in joining any rebound in economic activity. And to me, that sums up a larger part of the China's economic list of concerns and problems that may remain a bit durable for a longer time.
All right. I also quickly, because I'm running out of time, I want to understand what impact does that likely to have on India? We see that it is already impacting factory output all across the world. Are we, or do we continue to remain insulated, or would there be an impact in the longer run?
I think the biggest impact in economic scenario of India would be that exports are hurting, whereas the domestic growth levers are actually doing rather well, led by government-sponsored investment, capital spending, etc. And the consumption has also held relatively well, if I may say so, both urban and in the forthcoming quarters, perhaps the rural consumption will also be a support. So the biggest drag is thanks to exports, and that is more of a manifestation of what's happening globally. Impact on India, we have to segregate. The near-term impact obviously would be that of dealing with a slowing export engine, particularly on the merchandise or manufactured goods. But more importantly, I think if you expand the horizon, India stands in perhaps one of the sweetest spots in terms of attracting investment with the China plus kind of a story evolving over the last couple of years post-COVID, and India's push towards reforms, be it through PLI, be it going sequentially and thoughtfully so in securing its raw material, in ensuring the technology-enabled sectors. And when I talk of that, the semiconductor thrust by India's policymakers is a point to be noted emphatically. So all of it should, in my mind, provide a very opportune, longer-term platform for India's growth to, on a relative platform, of course, look far better amidst a macroeconomic stable environment that India provides, and fewer of the other regions across the globe are not being able to substantiate that with a greater macroeconomic stability.
All right. So it appears that India remains in a sweet spot. China's loss is India's gain, at least with the right sort of policy initiatives that the government is taking at this juncture. Shubhada, thanks very much. It's a pleasure having you on the show, a pleasure listening to you. We will, of course, try and get you back very, very soon. It's a story that we continue to track, that of, China plus one strategy. So far has augured well for us, Karthik.
Absolutely, Shweta. And I think, it's fairly clear now that China plus one, the plus one is India. But I think the game is now moving from that to the world squarely focusing on India and India plus whoever else. Okay. It could be Vietnam, it could be Philippines, it could be whatever, because the world has seen that too much dependence, over-dependence on China has hurt supply chains, has made China take this very, very aggressive stand on its own resources, on its own factories, on its own pricing, and on its own currency as well. So overall, I think the world has realized that a buffer has to be built outside of China. India happens to be the most opportune place right now to make those investments in. We are seeing those investments come in already, but I think India also has a long way to go to catch up, not just in the sheer volume of trade and the size of the economy, but even getting our own act together when it comes to critical industries like semiconductors, like EV batteries and becoming a manufacturing hub in equal measure as a services hub that India has been. That is going to be a slightly long road, but we'll have to take that difficult path and get there as quickly as we can.
All right, long road, difficult path. We're getting there eventually, and we bring you all those details right here on Newsline. Thanks very much for watching.
He thought he could outlast us. And 1 year later, the evidence is right here in this room.
Who will blink first?
So far from preventing